the line is that investing is the only business I know. Like, I've been doing this a long time. It's the only business I know where things go on sale, everyone runs out of the store. And the cheaper the price, the further they run. And to your point, in every other business, you put something on sale, people will run over each other to get it. But in investing, for whatever reason, when the prices start going down, people run away. And herein lies I think the biggest challenge of investing. Price is a liar.
Morgan Creek Capital's Mark Yusko gives his latest update and prediction for Bitcoin, and why investors need to look at more than just crypto prices in the final months of 2023. He says the market will see massive opportunity leading up to the Bitcoin halving in March of 2024. Yusko expects crypto summer to last until June of next year, and from now until fall of 2023, which is just a month away, we can expect a parabolic move in prices to occur. He shows how Bitcoin is currently undervalued, and investors are now buying and attracting speculators who seek to profit from September's price movements. This coming mass adoption is why Yusko says there will be unprecedented opportunity to buy in before the price surge to the six-figure target is met in less than a year. Let's get right into the latest interview with Mark Yusko as he gives his Bitcoin and crypto prediction for the coming months, and why investors need to rapidly seize this opportunity. Don't forget to share your thoughts and comments down below, and leave a like if you enjoy the content we do here. Let's get right into the video.
If you're excited about investing, you're doing it wrong. Right? No, you are. I mean, if you feel really good about things, you're doing it wrong. In fact, it's worse than that. If you make an investment and you feel good about it, you'll probably lose money. If you feel really good about it, you're going to lose a lot of money. If you make an investment and you feel a little sick to your stomach, a little apprehensive, you're probably going to make money. If you feel really sick to your stomach, you make a lot of money. And it's because by the time you and I feel good about it, it's already in the price, right? All the information's in the price. The market has already, and if you feel really good, you're buying something that everybody loves, then you've missed it. And that's why the average individual then rides it over the cliff. It's an interesting dynamic when you think about crypto and why we have this 4-year cycle. And we're in what I refer to as crypto summer right now. Well, what is crypto summer? Crypto summer is that time where the market has a generally upward drift. It's not dramatic, but slowly upward, higher highs, higher lows, just kind of, like a roller coaster, kind of moving its way up the track. And what causes that? Well, what causes that is investors, like myself, I consider myself an investor, have done the work, right? We spend hours and hours and hours looking at the value models and said, okay, the Metcalfe's Law model of Bitcoin, let's use Bitcoin as an example, is 55K. Now, you can say, well, that number's silly. No, if the price at 29 is lower than 55, then as an investor, I should want to accumulate. I should want to buy, right? Well, then what happens is as we get toward the halving, that'll happen next, April, and next June we'll shift into crypto fall. In that transition post-halving, crypto fall is where the traders start to come in, because we'll start to approach that fair value, and the traders just see movement. Trading is fine, and the good traders come in and they'll actually push the price a little bit, but then you get above fair value. Well, now the speculators come in. And in general, speculators are not even evil, right? What is a speculator? A speculator is just someone who takes the opposite side of a hedger. A hedger is like a producer. An oil producer sells using the futures market. Speculators take the buy, because for every sell, there's a buy, every buy, there's a sell. That's my favorite thing when people say, oh, there's excess buyers in the market. No, there's not. Precisely equal. And there could be on the margin, the next incremental trader could be one or the other, but there will always be an equal number or the market doesn't work. So then the speculators are there and they're fine. The miners are selling their coins and they need to sell more because the block rewards just went down. So the price needs to rise. Well, then the leverage comes in. And when the leverage comes in, speculators turn into gamblers. And the difference between a gambler and an investor is not just where in price relative to value, but also has to do with amount of work. Gamblers don't do any work. I heard that coin's good. I'm in. I find this cycle will get exacerbated and get exaggerated. And then when price exceeds fair value by so much, investors turn around and say, I'm out. I'm going to rebalance, because if I bought it early, now my weighting is really high relative to my anticipated desired weighting. And so I'm going to sell. Well, that triggers the downward momentum. Then the short sellers come in and they push it back down, and then people get margin called and we get the collapse. But that's when the cycle starts all over.
Yusko believes that Bitcoin and the crypto market have now entered into the phase of adoption, which investors have been eagerly anticipating. Prominent institutions like BlackRock carries considerable weight and signifies the growing influence and adoption of digital assets by major players in the financial industry. He believes that the recent shift in crypto will lead to a tsunami, unlike anything the world has seen yet.
Institutions, theoretically, are better decision makers than retail individuals. The problem is a lot of institutions suffer the same problem because they're run by small groups of humans. Yeah. And those groups tend to make equally bad decisions. The pension funds in particular have a long history of being just as bad as individual investors. So I don't know that the institutional money coming in is going to be quite the panacea that everybody thinks. Not all institutions are the same, right? There are long duration investors like endowments, foundations, some pension plans. There are shorter duration institutions. I mean, BlackRock would be that, right? An ETF is not a long-term investor, right? It's a daily liquid, tick-by-tick liquid asset that the institution, BlackRock, doesn't make the decision. It's the masses come in, the masses go out, assets go in. Look at ARK, right? It can go, lots of money can go in, lots of money can come out. Now, the scary thing to me is despite losing more money than she made, more money still going in to that ETF. So I don't really understand that. But the institutions are very varied. And if institutions like Citadel, right, which are the ultimate high frequency traders and day traders, come in, they have a very, they have a fractional of a second hold period versus, Yale might say, I want to hold this for 10 years, or, I might say I want to hold this for a decade in my venture capital fund, which we do. So very different. And the other thing that I think is interesting is this is not new. We've seen this before. GBTC was the perfect analogy. We know what happens when a institution, right? GBTC was a Cayman trust. That is a institutional pool funded with all of this other individual retail money. Now, it couldn't be retail at first because you had to be a qualified purchaser, and then qualified investor, and then you had to buy it in the private markets. But then a year later, you could sell. So then people could trade it in their PA. Well, what happened? We hit the $10,000 fair value, and then we went ballistic. I mean, we went straight up. Yeah. And everybody's like, oh, that was Michael Saylor and this. No, that was GBTC getting bought every day. Their asset base went from nothing, literally nothing, to I think 20 plus billion at the peak. And the thing about people forget is when the asset was 200 billion, and 20 billion comes in, you're like, oh, that's not that much. No, it wasn't 200 billion. At least 150 billion of that 200 billion was never going to move. It was the lost or stolen and the stranded and the hodlers and the people who are still accumulating. It was maybe 50 billion of free float, 20 billion on 50. That's going to put some serious pressure. Now we got this again, we got a $500 billion asset, and 100 billion of it is probably the free float. We're talking about 30 billion. If 0.1% of the 30 trillion of assets that are engaged in ETFs, is according to Eric Balkunas, who's an interesting analyst, 30 billion on 100, that'll move the price. But what if he's wrong? What if it's 1%? What if advisors like, I have an advisor and I haven't been allowed because, UBS doesn't allow you to own anything crypto related. When this thing gets approved and it's a BlackRock fund, they're going to have to let it be approved.
Yusko explains that while speculators initially drive price movements, gamblers entering the market disrupt the cycle by pushing prices beyond fair value, resulting in crashes. He also points out that historical trends indicate a roughly 10x increase in value with each halving event, suggesting that the next one is scheduled to propel Bitcoin from $10,000 to $100,000. Yusko emphasizes that the crypto market has become more significant and accessible to institutional investors and individuals alike, with real money flowing into it. He highlights the outperformance of Bitcoin as an asset class, noting that even a small allocation, such as 1 to 3%, could have significantly boosted portfolio returns over the past decade. This is why Yusko adamantly believes you need to buy in soon. What do you think about Mark Yusko's prediction for Bitcoin, and where do you see the price rising to before the halving event next year? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.